Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
G'day, thanks for joining us. Investing Insights with the Right Property Group, here with my regular co-hosts, Steve Waters and Victor Kumar from the Right Property Group. How you going, guys? You well?
Very good.
Excellent, mate. Excellent.
How are you finding this chilly winter that we've just moved into?
I'm a little over it already.
Really?
Bring back 40 degrees. This cold weather's just not for me at all.
I was looking at auction results yesterday on the recording on a Monday. It was a Sunday night where I sit there and watch the news. The only time I watch the news is on a Sunday. And they were talking about auction results. And auction results for the week are up, Steve, I'm told, rather than being down.
So up on the week before?
Up on the week before.
When it was a long weekend?
But down on the year prior. So I watch these every Sunday night. I just shake my head and I go, I don't know, number one, I don't know why they're even talking about it. Number two, is there actually any currency whatsoever in auction results?
Look, I don't think so. I mean, the barometer is 60% is a market of equilibrium, but there's just no context around the numbers whatsoever. The northern beaches might be at 87%, which is probably true. The western suburbs might be at 40%, and Central Coast might be at 20%. It's just it's an average figure, and if you put all your money based around the auction result numbers, no matter whether it's New South Wales, Victoria or Queensland, it's a pretty slippery slope.
So don't worry about it, don't look at it, don't think about it.
I think the only thing it does is probably drive some sentiment in the market via the media. You'll get some of the commentators around it talk about it like it's pure gold, but that's probably the reason why it gets some momentum.
Anyway, I don't know, Victor. I just don't know. Too many numbers in property investment.
Way too many numbers.
I get confused. What's the Victor Kumar key indicator?
Hang on,
I
thought in the last podcast we had an indicator, which was the chicken roll.
No, I think we spoke about it off air, but this is how many chicken rolls you could buy for. Well, some weird. You're a radiographer by trade. You know maths and science and calculus. I'm sure you've got some complicated formula to. I was going to say.
Do tell.
No. In all seriousness, Victor, what do you? So on a day-to-day, week-to-week basis, you work in property, you live and breathe property, you love property. It's what you do for a living. You're good at it. What are the numbers that you worry about to give you some sort of context or indicator about what the market's doing?
Look, I think by and large, it is the finance and the ability to get finance and how hard or easy it is to get finance. That dictates pretty much everything. If the finance is a lot harder, you find that less properties are going to auction, less properties are being sold, and properties stick on the market for a lot longer. Yet if finance is easier, you find that most properties get pushed towards auctions. Properties stay on the market for very few days. That's your biggest indicator, is how easy it is to get finance and of course, the ability to hold on to the property as well.
That's a really good point. So your ability to get finance probably encapsulates both macro and micro economic factors. So
it does.
The bank's willingness to lend is an indicator of regulation, prudential oversight, all these type of things. It also gives you a bit of an idea into what rate they're willing to lend, global financial markets, how they secure funds, the competition with lenders. So if you see interest rates coming down and specials coming up around particular rates or incentives, you know that, hang on a second, banks have got money to lend. So I like that as an indicator, and I think that's a really good point. What you've done there, Victor, thank you very much, is teaming up with a nice segue into the topic I want to talk today. And very much it's around, and Steve, you have said this for as long as I know you, that property investment's a game of finance, right? So it's typically the finance which would dictate how you go about creating wealth through property. And a lot of people use finance in very different ways as a tool, the engine to create wealth through property. And finance often dictates the strategies that you operate within in terms of buying. So myself, I've got a particular investment strategy that I use. I look to find under market value properties in sort of affordable belts that I can look to either add value over time or purchase under market value or do a renovation and hold on those properties and hopefully keep them as neutrally geared as possible to help me grow through properties. So that's one particular strategy, but there's a whole bunch of other strategies in property investment. You guys have some particular tenets that you follow investing in property, but we're at a point in the market right now where things are a lot tougher and have been tougher for quite some time. Victor, to your point, it's a lot harder to get finance right now. And I imagine there's a lot of people who have gone down particular pathways to create wealth through property who might be feeling some stress right now. For example, if one of your strategies is to live off the equity that you grow through your property and you can't get finance, well, you're probably eating baked beans and dollar loaves of toast, right?
That's correct.
So I want to have a chat about this. When you start seeing cracks appearing within your investment strategy, and what the hell you do about it, whether you need to act on it straight away or it's something over time that you can look to rectify. Is that a pretty reasonable way if we can follow that today?
Yeah, that is. And one of the key things that happens is, especially when there is a boom market or a very buoyant market, you see all of these new strategies that come up, which has been, dressed up to focus on the sense, be making it sensational, especially with Facebook and the social media these days. And as the money dries out and as the reality hits, what you find is that these strategies are no longer talked about, and we then reset to what really works, which is buying properties in fundamental areas, buying for the long term, and buying with the end in mind, and not trying to get cheap wins, because that's what gets you into trouble.
So there's lots of different strategies, Victor, and before we get on this path of identifying when their cracks might appear, it might be a good chance for us to summarise some of those strategies. So I just explained my strategy, and in many ways our strategy. You guys follow very similar strategy in investing in property. I've never sold a property. I've only ever secured properties, and this is a long-term wealth creation for me, buying under market value properties in affordable areas that at a point in time there'll be some X factor that I can realise. What's some of the other strategies out there, Victor, that you think we can just run through really quickly, just so to give our listeners some context of where these cracks might appear?
One of the key ones would be to buy, renovate and sell. So in other words, property flipping, as most people call it, or buy, renovate and hold. There are other strategies that could be dressed up differently, such as reps or leaseholds and so forth. And then over many cycles, we tend to see the live of the equity strategy dressed up in many different ways. These are just some of the ones that are more prevalent or more talked about these days. Certainly there's value adds like strata subdivision, house and land packages and all this sort of stuff. But I think the ones that stick out most in today's market would be your living off the equity, your value add properties such as renovate and hold, or renovate or sell, and not ignoring, of course, the original, which is buy and hold for the long term, and waiting for that inflection point where your rental income surpasses your holding costs, and therefore you can hold to perpetuity.
Okay, which is a very long term.
Yeah, that's right.
Fiscally responsible strategy, I would say. Right. But Steve, let's just touch on this
fiscally responsible.
Fiscally responsible.
He likes throwing in the words that I can't pronounce, right?
Yeah. Well, the words you don't know, Victor.
And hence comes the sledging, right?
Should have been nicer to me earlier, but
is this payback for before?
Maybe.
Before we went on air?
Yeah. Moving right along. So this live off the equity strategy you see, which it's a strategy which has held many Australians in really good stead. It's a strategy which is good if property is going up in value, but we're in a bit of a state of flux in the market right now, where if you look at the city market, for example, depending where you are, there's talk of softening of sort of 5 to 10%. Melbourne's similar. Brisbane is pretty stable. If you're down in Tasmania, you're probably increasing in equity at the moment, or you have done, but the absolute size of that, considering the marketplace, you're not going to be living like a lord on equity increases in Tasmania off base prices of 250 odd grand. So is it okay? Is it a market that we're in right now where it's possible to live off the equity? And I imagine there's going to be, it depends how much equity you've got, but what's your thoughts?
That strategy, living off equity, for me is probably the most dangerous strategy that there is. I think it's a fool's way, and I'm going to be crucified for saying that by a lot of other people, but nonetheless,
is living off the equity mean you live off, that's your salary,
that's your salary.
Equity. So that's your job.
Yeah, that's your job. So in essence, just for round figures, you've got a portfolio of $1 million, goes up by 10% a year, just for my maths, so it's 100,000. You can get finance at 80%, you draw down 80,000 and you live off that, buy a Rolex, a Bentley, a boat or another house. But that's really, really cool for whatever properties A, are going up, which they don't always do, and B, that you can always get finance, which you can't always get. So if we go into today's market, and let's just imagine you've got a Sydney portfolio that you've raped and pillaged, because that's essentially what you do year in, year out, that the market is contracted in certain areas, let's say by anywhere between, in our figures anyway, our data, anywhere between, say, 20% and 5%.
In Sydney?
In Sydney.
Okay, I was 5 to 10, but you reckon high as 20?
As high as 20, no doubt. And you've got a contraction in the price of your property, or therefore your equity base as well. Still got a mortgage to pay. Your debt's always increasing, so there's never an end point. At no point in time will you ever have that property as an unencumbered asset, if that's what the ultimate goal is. So you still got the mortgage repayments, but then you've got to get finance. And if your sole income is derived from property, banks just do not like that. And so trying to get finance to service the debt, and it's a vicious circle from there. I just don't think it's a safe strategy at all. And I'm yet to meet more than half a dozen people that do it successfully.
It's fundamentally flawed, right? So you're totally dependent on your ability to get finance. And this strategy really came into mainstream awareness back in the low doc days. And when you look at it now, those people that were equity rich, they could live the higher life, so to speak, but try getting finance now. With the way the banks are lending money right now, you'd have to then obviously, first of all, service the loan, service the debt, which is ever increasing, and then also have the ability, because you've got used to that lifestyle, have the ability to draw down more money to be able to maintain your lifestyle. You look at it in a sense that you're actually spending your wealth rather than your cash flow. And I'd rather spend the cash flow and maintain my wealth.
Well, cash flow is supposed to help you create wealth, right?
That's right.
So it's the opposite.
As Vic says, it's a flawed strategy, and it's just death by butter knife.
So is that a strategy though?
It
Living
is.
off equity?
Yeah. It is some people's strategy.
Yeah.
I mean, clearly you've got to accumulate the properties beforehand to a sizable portfolio in good areas for it to work. But it certainly is a strategy.
But isn't that sort of retirement though? If you create a large property portfolio, at a point in time you say, I don't want to work anymore, the idea is you either generate enough income from the rents of your property, and they're at a point where either they're paid right down, or you have a very low LVR so you can still service the debt and put some money on the table, or you start selling off properties. For many, that's a retirement. So is living off the equity just accelerating your retirement forward, allowing you to have the lifestyle that you want now?
Slightly, because when you retire and you've got the property portfolio, and if you were to do that, you've still got to service the debt, you've still got to be able to get a loan, and if you're retired with no other real income, well, it's going to be very hard to get that finance. So I look at it as a watered down version of a reverse mortgage situation, but early on.
Yeah, that used to be pretty common back in the late 90s, where you could get reverse mortgages, and so the target market obviously were the retirees, where the bank would come in and give you 20 to 40% of the equity as a set amount per year, with the cap being at 40% of the value of the property. But you look at it from a financial institute point of view, reverse mortgages right now are very hard to come by, and there's so many hoops to jump through, which tells you through and through that the banking system doesn't quite like that strategy either. And like I said in the beginning, property investment is all about finance. If you can't get the finance, you can't control the wealth. You can't control the wealth, you don't have a lifestyle.
It's a good point though, Victor, because in the big scheme of things, banks and lenders right across Australia have skin in the game. So for some people, they the bank might own 90% of the property. For some people, it might be 60%. Some people might be 50%. And the goal, property investment, or even if you're owner-occupier, is to pay down that debt so you own that asset. So any piece of debt sitting on, and we talk about residential property here, means that the bank has skin in the game. So the bank wants property to go up.
That's right.
Banks don't like property not going up.
It's not in their best interest.
No, it makes them very, very nervous. So reverse mortgage scheme means that the bank takes even more skin in the game, because they're speculating on the growth, whether it's positive or negative, in that particular property. And property over the last period of time has gone up in value considerably in Sydney and in Melbourne. In Perth, it's dropped considerably, right? So if banks were exposed to that Perth market during that period of time, giving people reverse mortgages, they probably would have lost a lot of money.
Yeah,
and banks don't like losing money.
That's right, and you can bet that there's a clawback system in that loan where they can force you to finance out. And if you can't qualify for a loan, or if the market is going backwards, no other lender will step in and take over that mortgage. Yeah, I guess the other side of the argument, which is people that are pro living on equity, they may be saying that, look, you're buying properties in the so-called blue chip area, and it's always going to go up. But hand in hand with that, with these areas, your holding cost is quite more significant than buying in the affordable corridors. So whilst on one hand you may have good growth or predictable growth as far as the data is concerned, may not be reality, you are also contributing a lot more from your pocket to hold on to that property until you reach that stage where you can actually, in inverted commas, live off the equity.
A couple of ways we could look at this. I think you're trying to give a balanced opinion on this particular strategy, and you're saying there's pros and cons for living off the equity. The reason why we're discussing this right now is that we're in a market cycle where this particular approach of property investment, people may start feeling some stress. But I'll put it to you, Victor. I'd say you're only saying this because you have a particular strategy. You feel as though that's the right strategy, and therefore that's what you think property investors should take. But I'm sure if we had some pro living off equity people in here, they'd probably be saying, well, your approach isn't right, and these are all the reasons why. So I think we should discuss that. Let's have a look at the strategy that you guys embrace, and that is buying more affordable properties in mortgage belts, I guess you could say. So these aren't the premium properties. These are the properties who are typically, out in the suburbs of the major capitals that don't give a big return in terms of absolute dollar value. They might be cheaper to hold, but they're not going to go up in value as quick. So
as a dollar amount, just to interrupt that segue, so we may get, just once again for the math's sake, Mount Druitt in its day might have got 10% per annum, and let's say Bondi did as well. Well, clearly 10% of $200,000 back then is not as much dollars as 10% of $500,000. So whilst the percentage growth may be the same, and sometimes it outperforms the average and sometimes it doesn't, the dollar amount is clearly not the same.
The point then is that, are you better off having the same amount of growth in more affordable areas versus more premium areas? You're getting 10% on both sides, but it all comes down to risk, right?
It does.
Are you going to be able to? Oh, there's a couple of things. Can you get more $200,000 properties, or probably now $400,000 properties, and diversify your portfolio versus one really good blue chip property that over time will probably perform quite well? So
look,
these are discussions that need happening.
Yeah, and that's a really good question. And once again, we don't profess that the strategy that we undertake is the only strategy. There's 100 strategies out there that are very, very successful. This just fits with our risk profile. And at the end of the day, and having spoken from experience, or speaking from experience, I would much rather control $200,000.
Absolutely.
Not $200,000 properties, but I'd rather control $350,000 properties than a 1.7.
What's a property in Mount Druitt worth today? Like a three-bedroom house.
$500,000?
$500,000.
Yeah.
So you park that same 500 in any other capital city in Australia, you're probably sort of middle of the road, maybe moving into your premium areas. And Tasmania, for example.
And let's be fair too. Just one person's premium is not another.
Yeah.
But we just prefer the more affordable corridors because it gives us consistency in our portfolio. We're not saying that the affordable properties are the only portion of a portfolio. It's just a really good building base. And then as you become more experienced investor, well, then you can branch out from there. But at least you've got a really solid base to fall back on. But we just don't do the blue chip. Blue chip. Yeah.
How blue chip would you go blue chip? So it's a tough one, right? Aqua chip. I think about your portfolios that I know of. I know you both have sizable portfolios. You've been in this game for probably 3 or 4 times longer than I have. You, Victor, were personally buying a lot of property out in Campbelltown 15 years ago.
Yep. 19 years ago.
19 years ago, when property back then was low $100,000s of dollars. Now, they're in many ways blue chip properties.
That's right. Yeah.
And I think we need to look at this context of blue chip. Blue chip typically means water views in an expensive suburbs, but in a city. Yep. And you said this to me before, Victor, that your mindset or logic around what it means to live within 5 kilometres of
CBD.
The CBD. So if you're within 5 kilometres of the Parramatta CBD, that's akin to being 5 kilometres from Adelaide. Parramatta's bigger than Adelaide. So,
absolutely. Yeah.
I think Campbelltown, I think Blacktown, I think Hornsby, I think Penrith.
I think Campbelltown's like 8 times the size of Hobart, isn't it?
It is. I'll take that on notice.
No, I'm just taking it. I'm just having a dig.
Yeah, well, I think.
But let's have a quick chat about that concept, because I know we're sort of shifting a little bit away from this idea of living off the equity in blue chip areas. But if you're within 2 kilometres of the Parramatta CBD, I'd say you've probably got a blue chip property.
Absolutely, yeah.
Today,
Today, absolutely.
I think the definition of blue chip has changed over a period of time, right? So when initially people talking about blue chip, obviously they're talking closer to the main CBDs, a postcode 2,000, 3,000, 4,000, because that's where the jobs were, right? That's where the people with the cash flow tend to live. But what's happened over a period of time is obviously we've got this decentralization where jobs with the advances in technology and all that, you could be anywhere and still maintain a decent wage and have a strong chance of getting multiple chances of employment. So your 5 and 10 kilometer ring of the main CBD is no longer relevant, and so your blue chip becomes your 5 and 10 kilometer ring within your employment node. So your in New South Wales, your Campbelldowns, your Blacktowns, your Parramatta's, and your Gosfords and Wollongongs, because that's where the employment is, and therefore that becomes blue chip, because there's a lot of money going through that local economy, given that there is new money coming in rather than old money, where people have now got their degrees, their masters, and they're working in more white collar jobs than anything else, and they don't actually need to travel into the city to actually do the job. Or if they are traveling into the city, the train journeys are fairly easy. Obviously, I wouldn't want to drive every day to the main CBD in a car. But the train journeys are fairly easy. The transport network is pretty good. So your blue chip definition, I believe, has changed significantly. So us investing in the affordable corridors, they're affordable from a cash flow point of view. They're affordable from a capital point of view. Yet the specifics of that property market is pretty much the same as your inner city in the main CBDs, except perhaps we're paying probably $10 less for our smashed avocado.
But just to get some context around the whole affordability scenario, as we mentioned earlier on, $500,000 is the affordable corridor in Sydney now. So we need to get some context around that. And I also think for us, affordable corridors might be affordable within an area. So we might go to, just because we're in, where are we today? North Sydney, that there might be some affordable corridors around here that are just well below the North Sydney average.
Yeah, absolutely. Well, if you consider this concept we're talking about, where you have this dynamic of blue chip areas within a 5 to 10 kilometres of an employment node, so a hub. Let's take Blacktown, for example. You could probably still buy a 5-row, 3-bedroom original house in Blacktown, the back of the TAFE there or near the hospital, for you're probably going to drop $650, $700 on that right now. Then if I drive down Sunny Holt Road towards Windsor Road, I'm going to be bypassing the ponds, and I'm going to be looking at property now 1.4 million
for the land.
For house and land.
Yeah,
and you're talking that's probably 5 to 10 kilometres. There within Blacktown, you could probably get a 2-bedroom apartment for 400. I haven't looked recently, but so there you've got a disparity of 400 to 1.4. If you go a little bit further out over Windsor Road, you're talking Castle Hill, and there you got 2+ million. You got beautiful properties out there. So that's the dynamic in action. Same thing from Castle Hill to Parramatta. It's about 10 kilometres or so, wouldn't it be?
And without Castle Hill without the infrastructure.
Without the infrastructure, well, they're finally getting a train line through, which is pretty impressive. But so this concept of affordability is a very interesting one, but it comes down to the fundamental principle of what makes property markets move, and the diversity of property around a particular employment node. And Blacktown's a city, Hornsby's a city, Chatswood's a city. But anyway, we got off the topic of living off the equity.
Before we do that, there's something that you said that was pretty pertinent, right? So which is very unusual. It is very unusual. With the price discrepancies in the Blacktown market, so in Blacktown Council area, so we've got your $500,000 properties, yet we've also got our $1.5 million properties as well. So there's a big gap between market expectations. So you've got a ceiling of 1.5, and you're getting in at 500. Obviously, the $500,000 property is not a 1.5 million property, but the residents in
same council area.
Same council area. The residents are used to now the 1.5 million as something that's tangible. So you get a far greater chance of growth as more infrastructure is poured into that, and the area becomes touted as being the affordable area. You get more people coming in there, and automatically the price resets. Because you've got a natural ceiling of 1.5, so it bounces up to that. I'm not saying that $500,000 property will become a 1.5 overnight, but you've got more chance of that happening.
So you say there's a much bigger margin in there. So like
Correct.
if you go back to your markets where we are right now, I'm looking out the window and I see Neutral Bay. Your percentage difference between your bottom property and your top property is
It's not that great.
Yeah, unless it's like a studio versus a mansion on the water. Yeah, it's interesting dynamics.
Just out of interest though, because you mentioned Blacktown, and
how's my numbers?
because I'm concentrating on what you've got to say. I'm on realestate.com, and I've just found a unit in the same complex that we bought for $220,000 in Blacktown, now on the market between $525 and $565.
Whereabouts is it?
It's in Flushcombe Road.
Oh, Flushcombe Road.
Yeah.
Okay.
So,
And how many years is that?
I know which number. I delivered pizzas in Blacktown when I was at university for 4 years, so I know every street.
break and enter is not classified as delivering pizzas,
Easy,
mate.
easy.
How long ago was that now? 10 years?
10 years, yeah.
Yeah, so 10 years ago we were buying them at the 220 mark.
Yeah, wish I bought some of them.
Should have known us.
Yeah, I know.
Right. Procrastinating.
Yeah, maybe. Anyway, was doing other things back
Yeah,
then.
it's concentrating in buying the blue chip areas.
I was. Yes. No. But so strategy. So how do you know, Victor, if you start to see cracks in your strategy? So we've spoken about one strategy in particular, that is living off the equity, i.e. property keeps going up in value, you keep refinancing it, take some money out so you can live, and hopefully it keeps going up in value. How do you know that you might start to find yourself in a bit of trouble? Or if you're probably doing that, you probably already know you're in a bit of trouble.
You probably already know you're in trouble because the bank's already starting to say no. And especially if the market's turning against you as well, you've got a double whammy happening. Yeah.
So what do you do? Sell up?
Yeah,
Weather the storm?
weather
Go get
the
a
storm
job?
if you can.
Become an Uber driver?
Yeah, that's true. Yeah, that's an easy
I
way.
actually know a mate who thought about becoming an Uber driver just to cover some short-term cash flow problems.
Is that right?
Yeah. A big property investor, good portfolio. But, yeah.
But yeah, you do have to actually then show up the cash flow, right? The negative cash flow, which highlights the main problem with that strategy of living off the equity is at some point in time, you got to find the money to pay the loan back. Yeah, and especially if the market's turning against you. First of all, you can't sell that really quickly because you've leveraged it to the hilt.
Well, and if it's prestige property as well, it's a lot harder to shift than a place in Blacktown probably.
Absolutely, absolutely. Yeah. So I think that if I were building a portfolio all over again, that would be one strategy I'd give a very wide berth.
Do you know what might be a good idea, Victor, is on the Smart Property Investment Show, so a sister podcast to Investing Insights of the Right Property Group, which I host, maybe get a proponent of the...
Oh, yeah, that sounds good already, yeah.
Of the live off the equity, and we roll out you or Steve or whatever, and we can do a bit of a boxing match, and
so long as you buy the coffee, Phil,
don't worry.
I think that's an awesome idea.
You get a Prestige coffee, it's $4 here in North Sydney. But what do you reckon? Would you be up for that?
Awesome,
head to head, toe to toe.
Absolutely.
Who else? Okay, so if we're going to do this, then
I can think of
and
three.
maybe this is something for our listeners, Victor, who. We've got a lot of passionate, loyal listeners to the Investing Insights Right Property Group. So maybe a chance for them to actually say, okay, well, I'm thinking this strategy, this strategy, this strategy. Let's pull some people in, and I'll do it on the Smart Property Investment Show.
That's awesome.
And so we've got you guys, the proponents of your strategy. Yep. We've got a live off the equity strategy. Who else would we want to pull in, do you think, or let us know?
I think development strategy. Developers, because that is a strategy, and there's a time and a place for that. I don't know, negative gearing strategy.
Is that a strategy, negative gearing?
Oh,
maybe
absolutely.
I could bring Margaret on. She'll Margaret Lopez will have a field day with that. So negative gearing is not a strategy, Margaret would say.
It is but a moment in time.
It is a truth. It's a tax outcome.
Yeah, but it is a strategy.
There's a lot of people who would go and sell that as a strategy. So.
Well, you only have to jump on Facebook and see the copious amounts of sponsored posts,
especially at this time of the year, right?
So it is a strategy.
Pay $3 tax to get $1 back, or
cup of coffee a week or a day, isn't it? Isn't that the catch cry?
Like that.
Yeah.
All right. I think we should do that. And if there's anyone out there who would like to throw another strategy in the mix, get in touch. And go through you guys, I guess, and pass it on to me. I'll do it on the Smart Property Investment Show. I'll bring it all in. And
what about wraps?
Wraps, options,
lease to purchase. Isn't it?
Yep.
Yeah. You can have a whole panel up there. You could have 10.
And can't make friends with everyone and pretty quickly.
And have the worm. The elections.
Maybe. The thing's that, I'm a part-time property guy. Like, I really enjoy catching up with you guys every single month, and we have a good chat. Me and you chat offline a lot because you work with me on my portfolio, Steve, but I am very much a part-time property guy, right? It's this is the nice part of my job when I get to talk about property. You're normally doing other things, which is very different to what I'm doing right now. But my view of property investment, and this is just my humble opinion as a punter who invests in property, I've got a reasonable portfolio, is that if it's complicated and hard to understand, and if I don't get it, you don't need to overcomplicate property investment. And a lot of people will overcomplicate it and tell you that's the secret sauce. So I think that's probably a good conclusion to this podcast.
Keep it simple.
For anyone, keep it simple. Let's be fair, we've spoken about 2 strategies really today. There's this living off the equity strategy, and it's a strategy that you guys embrace. But there's umpteen other strategies out there as well. So as a property investor, if you're tuning into this podcast, you're obviously looking to inform and be educated around property investment. You're probably going to hear of 100 other potential strategies. Some of them are going to be straightforward. Some of them are going to be very difficult to understand. And if you struggle understanding the concept of investing in property, I'd probably use that as a red flag to say, maybe if it's that complicated, it might not be the right thing to do. Because, Victor, it shouldn't be complicated, should it?
It should not be complicated.
Buy well,
Yep.
hold on to it, make sure you get your rent so it pays off the loan, and just wait for time to work
exactly right.
on your side and hold it for a couple of property cycles. And
Yeah, and also you need to be adjusting your strategy in line with the market. So as finance gets
Good
harder,
point.
you need to start looking more cash flow, or actually stop buying for a little while. If you're just starting to build out your portfolio, you've got to start from good fundamental areas and make sure you're looking at your the amount of negative cash flow you're going to carry as you in the build phase or the acquisition phase of your portfolio. But I'm a strong believer of you shouldn't have the loans hanging around for a lifetime. You need to actively look at ways of paying it off so that you can control the cash flow. And then all of these strategies and the dilemma of which strategy all fades away because you're actually controlling the income. And that's what investing is all about. You're controlling the income and you're letting the wealth creation happen in the background. In other words, the equity build-up happen in the background.
so look after your cash flow.
Correct.
And the equity should happen.
That's right.
Fair.
Sounds good.
All right, as a conclusion, I hope we've done a reasonable justice to this particular topic.
We got 2 strategies out of the way.
2 strategies out of the way.
The other 22 we didn't really touch on.
Yeah, they're out there though. If you're wondering, how you find out more different strategies, Google property investment strategies. You'll come up with 1,000 of them. Victor, let's sign off. I think. I think it's been a really good podcast. How long have we gone for? Way too long. What can people do if they want more info from you guys? How do they track you down?
They could send us a email on questions@rightpropertygroup.com.au, or they can reach out on our Facebook page, or just go to our website, rightpropertygroup.com.au.
Or they can ring us.
Or they can ring us, yeah.
Call you. Do you have a 1-800 number? 1300?
1300 302 166.
There you go. Cool. And questions as well. We've got... I know you've got a folder in your email with all these different questions sort of tucked away. Are we ready to do a Q&A session?
Yeah, we might do a quick Q&A session sometime soon because there's quite a few questions that have come in.
Yeah.
And most of them have got a common theme. So we might group them and attack them at that time.
Yeah. And if there's anything particularly you want to know, just email Victor and the team, questions@rightpropertygroup.com.au, and make sure that you are included. Steve, any parting words of wisdom? No? Okay.
No, I've got nothing.
Victor, you've always got some parting words of wisdom.
Steve's already departed.
Is it?
Yeah.
Is it a good time, Steve? This is your last chance.
Oh, here we go.
I'm going to give you 30 seconds to answer this question. Is it a good time to invest in property, and why or why not?
As long as your financial footprint is under control and you have ample buffers in place, whether it be capital or cash flow, there is always a market somewhere if property investing is your thing. GFC is a really good example of that. It was an awesome time to invest in property. So yes, is the short answer. It is a good time. Just make sure that every bit of mitigation that you have is in place.
Fair enough. Victor, I'm going to give you the same opportunity. Parting word of wisdom.
Listen to what Steve says.
Yeah.
So one more thing though, just because we're way over time. There's a lot of doom and gloom in the media, but let's not get too far ahead of ourselves. Money is cheap.
Yeah.
It's just
Very
that the
cheap,
banks
yeah.
are limiting it to who they're wanting to
And
lend it
financing
to.
cycles will change as well. It's not
It
going to be like
does.
this forever.
Yeah, we don't have a GFC scenario where prices are free falling, and we don't have interest rates at 7 or 8%. It is very, very cheap money. So
Just look at the fundamentals in terms of
Yeah.
qualifying for finance.
Yeah.
Get rid of those car leases, get rid of those credit cards. Make
and that'll
yourself
improve your
more
borrowing
attractive, yeah.
scenario. It's just people still need accommodation over their heads. Immigration and population growth is still very strong. Employment is not as strong as the government would like to see, but money is cheap. Consumer confidence is high.
Cool. Well, I hope you enjoyed that. And remember, there is a whole bunch of other podcasts, Investing Insights of Right Property Group, that we have recorded over we've been going for about nearly a year and a half now with this. So there's one every month. Pretty much anything you've ever wanted to know about property investment, you could probably go and find it in one of those podcasts. The most previous one we did in May, 25th of May, was breaking down the investment process, where we just spoke about some of the boring stuff associated with being a property investor, and that is like following the process, but it's the stuff you absolutely need to get right if you're going to be successful. Go and check it out, and all the other podcasts that we've done. And as we said beforehand, any questions at all, whether it's about this podcast or anything we've done in the past, Steve and Victor would be happy to take your queries. Questions at rightpropertygroup.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.